Of course, with all the presentations that we give, where we're discussing the startup market, startup investments and funds, you have to be aware that these are risky investments. So while today is mostly about the market, the growth, the trends that we're seeing, we will mention our fund as we have to. And because our fund is an investment opportunity, we are required to show you this risk warning. You've all probably seen this before, but please do read it. I'll give you 10 seconds. Effectively investing in early stage companies involves a high degree of risk and is illiquid. Therefore, you should never invest more than you can afford to lose should you decide to invest in our fund or any fund. SyndicateRoom is authorized by the FCA. Our FCA number is there on the screen, 613-021 for anyone who wants to look it up. And we are based in Cambridge, of course. That's probably enough time for you to have read the risk warning. Today's presentation, and my colleague Graham will be joining us shortly, as a lot of the work was his, was on the process that we went through, the research and data analysis on indexing the venture market. So looking back on the last 10 years of data, which could help you inform your investment plans. Now, for those who are familiar with SyndicateRoom, we did run a similar set of data a few years back when we were kicking off our Access EIS fund. It is a big effort, but over the last couple of years, we realized that we hadn't kept the entire index as up to date as we wanted to. So we spent a fair bit of time updating all of that information and looking at all the companies that have raised at least £100,000 in equity, going back to 2011, looking at all the different cohorts, as you'll see, in the data that we're going to get to. But just so you know, this is updated from the original research and analysis that we conducted initially. Graham has joined us. Graham, you are a panelist. We can hear you.
Yep, I'm here. As long as you just enable video, that's the only thing, and then I can get started.
Yeah, give me 1 second. I'm not as technically advanced as you are. It'll take me 1 second.
Yeah, right, so just enable videos. Thank you, everyone. I appreciate a bit of a delay there, running in from an investor meeting that we had. So today we're going to be talking a bit about the latest research that we've done on looking at the startup market, looking at basically going through companies' house filings to better understand three main points that we're looking at. Number one, what growth is happening in this part of the market. I think there's obviously a lot of headlines and stories that we see there. What options are there for accessing it? And how can you really build it as part of your potential portfolio? I think a lot of people see, we're going to talk about the growth there, and that's fantastic. But also what are, it's not just growth. You need to figure out how you're going to get in there. All right, great. We're in there. Don't necessarily have video. May I'll just have to talk over the slides for now. Let's see. Can I start video? There we go. Great. Okay. Now you got a little mini me. I'll try with my head if I'm blocking anything. Let's skip over the stuff Tom's covered. Probably told you a bit about us. We look at this data all day. It's how we do all our investing. So thought we'd share a bit more about what we're seeing. So we know it's been a tough year. We've seen, various returns on bond markets and equity markets. So we wanted to explore a bit more about the venture market. You see a lot of headlines. You see, obviously, interest rates being held, but having raised rapidly over the past 12 months has an impact on the markets. We see headlines like WeWork going down. We see, though, this AI market exploding, companies raising 105 million, being raised almost at like $1 billion on their first raise. Other people saying that VC activity is going to be picking up. We know EIS is still doing well. We know there are IQ Capital, I've taken as an example, but there are lots of VC funds that are still raising money. So we built this. We wanted to really figure out, what value is accumulating in the market. Let's look at 10 years of data, figure out what's happened. How is the growth distributed? So where is this growth? How many companies are doing well? How many are doing badly? And what impact can it have on portfolios? So how do you figure it out where to go? And yes, please, I see people doing chats. I see people doing stuff on Q&A, and that's no problem. I'm happy to go through questions and chat through that. Let's start on the big number, the first question there. So what value is accumulating in the market? And then I'll talk about, as I said, the growth distribution and how you can actually access it. And especially I'll be able to answer your question, Adam, quite easily, I think. So let's say that we wanted to first index the market. So what is an index? An index is basically this, when you look at the market cap of them, of all the companies, you take the valuation of all the companies and you track it. You see how the valuations have changed. We base that on subsequent funding rounds they've had, exits they've had, and of course, when they fail or they just stop being active, we mark them as 0. So for this first index, we took it at looking at all what we would call quote unquote investable companies. So these are companies that are raising at least £100,000. They are valued less than 50 million. So nothing that's too late stage, that's too hard. That's it. Once you get past 50 million, it becomes really hard to access. It's only stuff that large VCs tend to be, not really individuals or even, EIS funds that individuals can access. So then they are also UK based because this is all based on companies' house data. We only looked at equity deals. There are other deals that happen called advanced assurance agreements and convertible loan notes. Now, those don't show up in companies' house data, say because they're not actively equity. They can convert into equity and then they'll come on later, but we're not including it as part of this analysis. And yes, as I mentioned, we do set companies to be worth 0. So they may start at the valuation. Let's say they did an initial raise at a 5 million valuation. 5 years later, they did, then it goes to 0, and they aren't included in the index, but they were obviously included in that original amount. So when we do this and we just track the total valuation of the companies, and we take it by cohort. So what we've done here, and I spoke about it in an article, is we look at every company that raised capital in 2011, and we block that set of companies off, and we say, look, they met those criteria in 2011. Let's call this the 2011 cohort of companies and see how they do. And then we track what happens to their valuations over time, and then we repeat that for 2012, 2013, 2014, 2015, etc. And look at the total valuation. So that's why this one is based on pounds billion. And you can see that every single year it starts at a slightly higher point. That's because, number one, there are more companies raising money from when you look at 2015 compared to 2011. And number two, the average seed valuations and early stage valuations are also higher. So even the companies that are doing their first rounds are on average raising at a higher valuation. And this is simply, again, like I said, we're not trying to take an unbiased view. We're simply taking all these companies and tracking their valuations. And you can see that there's a lot of growth. And I guess this is probably where that headline comes on, that the marketing team wrote around perpetual growth. And it just means, the reason we've used that is that whenever we do track these cohorts and we use every single company in there, it does paint a picture of, consistent growth in each one of these groups of companies, these cohorts of companies. Now, it's important to note that you can't achieve this exact growth. There's thousands of companies in here, and it's impossible to access every one of these investable rounds and put, £10 into each one. So our point here is not to say that this is something you can go put your money into and capture straight away. Our point here is to say that there is a lot of value accumulating in this part of the market. Now, I'll talk a bit more about the distribution of that and where it's coming from, and we can illustrate that further on value accumulation. And that's mostly, again, restricted to most individuals that are looking here. If we index it, so if we rebase it, I should say. So we take this, and let's say we just want to put it all started at the same year and at the same value. So that's why we take it at the £10,000 value. And we say, obviously, well, let's say, hypothetically, if you'd been able to invest £10,000 proportionally across all these companies, what would have happened? Again, I said hypothetical because you can't actually do that. It's very hard to do it. This is the kind of growth you would have seen on valuations, at least. I have done a similar one looking at actual exits, because it is one thing to look at valuations. in this market, and another thing to look at actual cash returns. And we look at the cash returns, it's not as high, it's more around 20% annual growth. It's still pretty good. And that's looking purely at just the ones that have had exits, including them as part of your original investment. But you would still have additional value, and I think to come on the cards. So look, it's easy enough here to draw the comparison to the FTSE. We obviously decided to include it, and it's not necessarily the right comparison because the FTSE is liquid. I haven't included dividends as part of this. I know people have asked about that. So dividends would make that FTSE line slightly better. I don't think it's obviously not going to catch the same amount there. But I also can't track dividends that the startups do, although they are quite rare, or any secondaries or anything that happens there. So the point here again is just to show that hypothetically, if you could get this in, there's clearly a lot of value to be had, and there are people who are accessing it and able to get it. It's very distributed in an interesting manner, and that's really what my next slide will talk about is, why can't I just go in and get these returns? I think this Adam's question here is bet. He's invested in 4 EIS investments 4 or 5 years ago, hasn't got a penny from any of them. It seems like salespeople for investments are hyping up extremely high risk startups, and the likelihood of making a profit is almost zero. And that's not what I guess I'm trying to say here. Yeah, I'm not trying to hype up a single investment. I think that's an important thing here. A single investment, even 4 to 5 investments, is pretty risky. And I'll show you in the next slide why. This is looking at a market level. It's the same as, I guess, if you're picking 4 or 5 public stock investments without let's say this market is very obtuse, right? You can't go and access every one of these companies. Now, imagine you were doing 4 or 5 investments in public markets, but you had no idea the full scope of public markets. You just put your hand in a bag and got 4 or 5 deals. You could be getting, really bad set of deals there. And sometimes it is even worse than that because entrepreneurs, and they are always going to paint the best looking picture because it is high risk. And that means that for you to make your investment, you need to have potential of multiples of your return. So you're only really going to invest in these companies if they have that potential very high growth curve. And it's the same thing that VCs do. VCs will go and invest in, let's say 8 companies. And they will only invest in those companies if they have potential for returning the entire fund. So they will only look at the companies where the entrepreneurs are saying that it's going to have potential to be a 10 or 20x. Because they know that the other 8 or 9 companies they invest into could just go to zero. But they need that one to come off. And that's a lot of the weird dynamics of this market. Question here, I'll address it quickly. The data goes back to 2011. Economic conditions are significantly different at the moment, particularly regarding inflation and cost of capital. Is anyone integrating the impact of different investing conditions into the conclusions of these points? Yeah, that is a fair point. I think 2011 to 2022 was obviously a low interest rate environment. And there has been a lot of capital available to a lot of the startups. Having said that, as I've shown you before, there are still VCs that are raising a lot of money and will be looking to deploy it. We can't go further back. I mean, we tried once. Let me explain why. First of all, we can't go further back because of the way companies' house filings were done. They were a lot more handwritten as opposed to PDF based, so it's harder to figure out that data. I have done one article that looks back at the Great Recession, 2007 or so, and it still looked pretty good. It's very similar. When I say good, similar. And there were obviously, I must pull up the article. There were a lot of, you can look it up on our website. There were obviously some very successful companies founded in that period. Going forward, 2023, it's tough because I think I mentioned this in the article. We don't have all the full filings for it yet. So yes, we do only look at 2022. And all accounts, if you look at Bohus data and the tracking that they're doing on the number of deals is definitely lower this year. I do know if we look back at 2020, there was an appreciable dip in valuations, which was obviously just almost a temporary dip because of the odd market conditions that we had. and then suddenly it picked up again. It is hard to predict. I think what I still believe in is that the fundamentals of the market are good. That there are a ton of new companies being formed out there. There are still a lot of angels investing. There's still a lot of VCs. As you've seen on the AI stuff, there's going to be more advancements. There are going to be unicorns founded this year in the future. There will be unicorns in the future. I just believe that will happen because there's such a history of it happening. And there is so much activity still going on. What you will probably see less of is maybe a lot more of the middling companies not happening, or being able to continue to raise capital just because people are looking to deploy capital outside of a low interest rate environment. Adam, I mean, you want to share terms of net profits being made, but I'll talk a bit more about our fund. I want to focus more just on this analysis and that we're looking at here. Before we get into that, I'll cover more about our fund at the end. Because it's not ready. Yeah, idea is not ready here to pitch our fund. We do this analysis, and I'm putting it out there to help people make investment decisions and figure out how to build their portfolios. I did this quick analysis here that kind of looks at, without seeming overly optimistic, the initial analysis kind of is a bit weighted. So it is weighted towards the bigger companies doing bigger seed rounds, or because we use that kind of wide 50 million can pick up companies that are at the 50 million valuation. What I did was also rebase it and say if you invested exactly, let's say £10 of your 100,000 of your £10,000 into every single startup in there, and it produces a really interesting graph, and it matches other analysis that we've done that shows that you're much better off writing fixed checks into companies as opposed to investing more into companies that are valued very highly. So instead of putting, in that previous model, if one of the companies in the 2011 cohort was valued at 50 million, it gets a higher weighting at the start. Whereas this model says, don't weight higher than that, still put a lot into these very early stage stuff, which a lot of them will go bust. But when you're putting £10 into a 5 million company, your return on when that 5 million company becomes worth, when it becomes $1 billion is much higher than when it's 10 times, I guess, as high as what it would be when it's a 50 million company. So I don't want to harp on this, but we've got another analysis, and it's in my original white paper, that talks about fixed check versus variable check when you're investing. So the other bit of analysis I thought I would share that simply looks at how many of these companies succeed once they hit certain multiples. This is probably a bit more nuanced, and I hope I can explain it well. But what we did is look at companies based on their original funding round. If they make it to a 2 times multiple on their original investment, what would the likelihood of an exit be, and what is the likelihood of them raising further funds? So if you look at the initial group of companies that we look at, it's quite a high exit rate. It's around 20%. I mean, I'm not looking at positive exits. I'm mostly just looking at exits, and sometimes they can exit to a company that's not necessarily doing that. Well, that's bought them on the cheap. But it's still interesting, I think, nonetheless, to look at. With that initial cohort, what companies do manage to do their initial rounds, around 20% of them will get to an exit, and almost 90% of them do get to a larger round, which is also interesting. And I think that's probably just because the fact that they've been able to raise that first round, they are able to get some traction and convince people to invest more. And when you go on further from that, the likelihood of a larger round decreases, and the likelihood of an exit kind of hits a peak at maybe around 50%. You can never really get much higher than that on the average stage. So we're looking into this data a bit more, at least as predictors, and figuring out ourselves, at least, that we should be investing further into certain companies. And I think there's some interesting things that you can do there. So let's look at the distribution. So there's a lot of questions here around, I'm not, I've made a few investments and I'm not really getting much. I think it's important to understand with this market around the power law. And the power law, as many people might have heard about for this market, is very active. And basically what it means is that the returns are really concentrated on just a few companies. What this is a standard statistical model that shows you your normal distribution, a bell curve. I haven't shown the full bell curve because obviously we're going to negatives compared to a power law distribution. And if you look at what percentage of the population fits under the curve. And if you look at the power law distribution, at the normal bell curve distribution that people will know about, you kind of get a peak in the middle valuation at the mean, and then you taper off to either end. The power law is very different, where you get majority of the population sits under one end of the curve, and you get this really long tail that stretches out almost indefinitely. And what that looks like in practice, without having to give a stats lecture, is if we look at this data and we simply line up all the companies from lowest valuation to highest valuation, you can see that 80% of the value sits in the top 6% of deals that were done. Now, that's why if you're doing 4 or 5 deals, you have to wonder if you're able to get those 4 or 5 deals into that top 6%. That's really what it eventually comes down to, this market. How it's 2 things, yeah. How many companies you're doing, and how do you get into that top end of the market? And that's where a lot of people are obviously burnt, and a lot of the VCs will pitch it as their ability to get into these top, accessing these deals. And if you look at any other GPLP and some of the bigger VCs, they all have a slide just talking about access, and how do you convince some of these entrepreneurs to work with you and get into them. And it is the deal sourcing machine that every single VC has to figure out. And there's the power law working there. We've done another one on this slide, probably I didn't actually include it good. So the slope of this curve is something called the alpha, and that tells you basically how fat the tail is going to be. Like how many companies are going to be concentrated at this end. And if you can model it and say, this really speaks to the number of deals you should be doing. But basically, eventually, if you keep doing deals, and if you could do the entire market of deals, you will eventually get one of these bigger deals. Let's assume you can figure out the access problem and accessing these companies. But doing more deals means you will eventually get into the really big return deals. And that's kind of what this slide shows. So, I mean, our belief is, and I'm not the only one, I think there's other articles, you can look it up, that do argue for doing larger portfolios to increase your odds of getting access to getting into some of these bigger deals, and the argument for diversification in funds. So that's really going back to, so we started on the first question about looking at this index and tracking the valuations and seeing that there is growth in this market. And the second question was, how is this growth distributed? It's very concentrated. It is hard to access. And it really is about that ability to get into this top portion of the market. The third question is, so, okay, let's say you decide that you do want to look at venture as part of your portfolio. Harman did this report, white paper. We have it on our website. If you can't find it, let me know. Which is about how much clients, because it was very focused on IFAs, but it's really about how much should investors invest in venture capital. And I put this here not as our own research. We did sponsor the paper, but to just show an independent view on it. And I think it was a very well written paper. Brian already wrote it. I've done a podcast with him before on that, so I'd recommend checking out his work and his podcast that he does. But this looks at, but what they've done is looked at, some of you might be familiar with the capital pricing model and the efficient frontier. And basically, if you use uncorrelated assets, you can improve your returns whilst reducing your risk. And he's taken some other studies to look at how correlated venture market is with equity and bonds, and plug that into the capital pricing model to figure this out. I'll go there's on the chat. They've included the link to it. And basically what he finds is because of the relatively low correlations and the potential returns, despite the very variable risk that's involved, by including a portion of it in your portfolio, you can improve your expected returns at almost all different risk levels. Most of them will look at around 10% standard deviation risk, and it can increase it by 1%. Now, I've included the number there where it's looking at 22% expected return on seed deals, which you may have your own view on, which we've obviously based on. It's not based on our number. This is, again, based on this independent research and looking at other examples and other studies that have been done. And with quite a high standard deviation, quite a high risk factor. But because of the lack of correlation, especially, I guess, when you look over a long term, and the potential for returns, it does work well to include it as part of a portfolio. How much? I guess you might say 1%. It's not necessarily worth the risk. Again, the argument would be that, again, no matter the lack of correlation, even if it is risky, it should still, in theory, improve the returns of a portfolio. And even that 1% can lead to, a big difference on a £50,000 investment. That's really what this slide will look at. And it increases even more when you consider the tax relief. So on all those previous slides that I've done, we never include tax relief. I'm purely looking at valuations. And that's why no tax relief, if you look at a 17% IR, if you add in that 30% tax relief from EIS, it jumps up by 7%. It's quite a lot. And then, yes, you can also get your loss relief on EIS, and capital gains deferral goes even higher. If you're here, you might probably be aware of EIS and the tax benefits already. We have it on our website. I do an EIS webinar, so if you're interested in that part of it, we have a lot more information. But in addition, these numbers don't even look at the tax relief, looking at the potential improvement it can make. And then including it as, I haven't even included it here. And if you check out that paper, he also talks about how much you should include. I think it's around 5 or 8%. It's not saying do a ton of it. It's saying just add it as part of your portfolio, because it has this potential to increase returns without increasing the risk of the whole portfolio. So it's a great paper. I do recommend people look at it. So really what I've tried to answer today is these 3 questions, or at least help with them. What value is accumulating? As we said, a venture market showing annual growth rates of 25 to 31%. How's the growth distributed? Concentrated at the top end. Understand how you're going to access this market, how you're going to access the top end. And then we obviously also recommend doing a lot of deals. We work with a lot of angels, and I can promise you the successful angels have done a lot of deals and had a lot of failures in there. What impact can it have on portfolios? So again, now quoting the research done by Harman to say that rebalancing it can add, a 0.5 to 1% on annual growth to your portfolio. So it is definitely worth considering and looking at how you can add it as a small part of let's say, your equity and bond split that you have. I've written a lot more on the market and analyzing it and running investment models. I can talk a bit about the fund a bit more now. So our fund does take this diversified approach based on other analysis I've done. We've got 2 other white papers that are available. And the second principle comes down to that access part. How do you get into that top, 10%, 6% of deals? And we work with angel investors where we use the same data to look at every deal that they've invested into. We can see that they have accessed that top 6% before, and that's why we invest with them. And that's how we try to solve that part of it, combined obviously with that diversification element to maximize the potential one-off deal in return that you can get. So that's us. You can go find out a bit more the fun in that and why but I guess that gives you a taste for why we invest that way anyway. So let me go through some of the questions here. I think yes, the first one I've spoken about, the number of investments, and why the 4 or 5, it's so hard to say. If you've done 4 or 5 investments, it'll be about how did you access them, but also similarly, it's high risk. So 4 or 5 might not necessarily be enough. and I don't want to push you to do more without taking another good look at how you came across those deals and got into them. Question here, very respectively, valuations mean nothing. It's like someone marketing their own homework, marketing their own homework, I think that is. What counts as exit and money paid back to investors, but that key information is cleverly kept behind as it shows these investments are worthless. I mean, we will put something out there on exits in the future. I don't think you could say, yes, okay, let's say, you can't say like an investment in Revolut is necessarily worthless. It has been valued. People have invested, and a lot of the early stage investors would have got secondaries and would have sold on those billion-pound valuations. I'm not even necessarily tracking those secondaries. We've had funds and our own deals on that where secondaries are always an option. I don't think saying that they mean, I think saying they mean nothing is just a step too far. I think there is a huge caveat, and that's why I made the statement earlier that there are valuations. I want to be that clear with investors. I'm not trying to hide the exit stuff. We will get around to it. I think valuations is just an easier one to do because exits requires a lot more work to track down exactly how much was sold and figuring that stuff out. So there's more work involved with taking a look at exits. But they have definitely, I think the company's valuations are suggestive of either likelihood of exit and also the eventual exit value. And sometimes it's even conservative because sometimes the exits happen at much higher valuations, but sometimes lower too. Nigel asking us, do we do any SCIS? If not, why not? We consider it. I think now that they've expanded it to 250, it is worth looking at a bit more. I think previously it's been hard to get a meaningful check size, and you have to invest a lot of time into getting SCIS, which means cost, which means fees to both companies and to the investors. And I think you're better off waiting to see some. I mean, we've run a lot of different models, and you basically are weighing up risk versus return. And what we take the stance, and when we've done the numbers, is that when companies get to the point where they're at least raising 500,000, which is normally just post SCIS, they've had enough evidence and traction to attract the right angel investors who aren't necessarily just after the big tax break of the SCIS and go into it there. But we're reviewing it. I don't want to say we'll not do it. I think, as I said, now that it's increased, it's a bit more interesting to us. You can't necessarily put that much through it, I guess, is the other thing. I guess they're not theoretical valuations. They are market price valuations. We're not sitting down and saying, I think that company's worth this much. There are investors who've come in and figured they can still make a good return by investing in this company at this price. And market-based pricing is one of the best tools that we have. We can't use future returns. We can't use cash flow, future FCF models and that kind of thing. Yes, I still agree exits and everyone, the proof is in the pudding, and the cash returns that people will get out of it. But as I've said before, and the data will clearly show you that the valuations are indicative of the returns, the exits that companies definitely get, and that people are willing to pay that for that price. But yeah, I totally get the point. Has anyone said I did miss slides? Yeah, we'll share the slides. No problem with that. The data in terms of net profits being made by your clients. Yeah, I mean, I hold the webinar about our quarterly returns performance and talk about that. I mean, our fund itself is still early. I can tell you, looking at this data, the time to exit is long. You're looking at an average around 7 years with variation on that. There are very, very few quick lunches and get rich quick schemes in this market. You can try invest later when they're closer to an exit, but then your potential returns is much lower. It is a long-term game, this, which is why it's still good to be part of a portfolio, as long as that's not, the portfolio that you need immediate access to. It is part of better placed as a long-term portfolio. So happy to take any other questions about it. Yeah, the webinar about our fund performance and that. So we try to be very transparent in our approach and tell everyone this is the investments we make. We aren't, I'd say, less than other funds, emotionally tied to particular investments. So we're happy to take the wins and the losses and just talk about them because our approach is, as you've seen, much more of a statistical approach to the market than, I guess, how others might take it. Happy to take through my emails there. Tom, who was here briefly, his emails there. Any other stuff you want to send through, happy to do that. There is an article on the website that covers a bit more of the initial slides. I've talked about a lot more today than what's on that article. And I'm hoping we can do more with the data and just show people other facets and dynamics of the market, so that again, we've looked at the data and we've designed a fund based on that and said that this is what we think will work. And we're 3 years into it, and we're seeing really interesting companies in that come out, and we're happy to talk about that journey and everything. But I'm sharing this data also so that more people can use it to inform their decisions. Question here about the sectors, split evenly across sectors. So sectors is something I've only briefly looked into. We're seeing obviously a lot more stuff necessarily go into AI. I remember I looked at the AI cohort before this year, funny enough, before ChatGPT and all that took off, and everything that they're doing. And even AI then, and companies that were they're at least using artificial intelligence in their main description, which might be companies that aren't doing artificial intelligence. It's too many companies for me to go through and actually figure out which are which. And that as an investment vehicle would have done very well, doing an AI fund, just starting it in around 2012, 2013 and investing in every single artificial intelligence label deal you could. So I have seen stuff like that. We have done there's regional analysis and splits to do. I did it originally when we ran the very first analysis in the first white paper, and we still need to do it on this now that we've gone and refreshed and updated it. But I do have it. It's tricky though, because again, looking backwards shows, if you look backwards, for example, today, despite I guess what I've said maybe about AI, you would have invested a lot more in, say, fintech. And fintech has now really come off the boil in 2023, and everyone's redistributing it towards clean or green. AI is the other, obviously, the one that's doing well. And healthcare and biotech and all that, right? Those are the top 3 at the moment, and fintech's really come off the ball. And you're probably going to see less big valuations and companies coming there. So yes, maybe you look historically, you'd be like, well, fintech would have been great, but now things have actually shifted to another sector. So that's always the tricky sometimes thing when you look at these things backwards and try to make decisions that way, because it does change. Our approach is very multi-sector, or sector agnostic is the term that the VCs like to use. Nuno's mentioning, are we looking at integrating LLMs? I would love us to look at the qualitative factors of companies, because right now we look purely at quantitative. We look at who else has invested into it, what's their valuation history, what is their funding history, and all those kind of hard numbers that we can do. Qualitatively, I'd be much more interested in pulling in data such as the entrepreneurs' profiles. I would love us to look and then compare that obviously to other data, and then you would need training, so we'd also have to spend time training it, and then making sure that it fits all data and everything that we do, and we've obviously the base based on whatever the entrepreneurs have done. And then also obviously we get a lot of decks. I don't know if the net decks can be as predictive, but I'd probably as a starting point, I'd want to look at LinkedIn profiles or full CVs of the entrepreneurs and use that as a helpful way to predict. And yes, also for deal sourcing. I know there are deal sourcing. So that's one on actually selecting the deals. The other one is actually on sourcing the deals, because there are a lot of startups out there with obviously websites that you could read information about and pull that in, because we have to, again, the reason we use the angels is we need to get into the deals before they happen. We've got this data about all these deals that had happened, but then the deal's done. The bird has flown the coop, if you will. Chickens flown the coop. The LLM does have the potential to help you identify some of those deals before. And yes, it can maybe do it by looking at the entrepreneurs' profiles and say, oh, well, they're in this area. They've got, profiles that match everything else that we've seen. Take a look at these companies. And yeah, just generally scraping the internet and taking a look through interesting websites. So I will say there is a big VC fund that does use LLMs a lot more. Moonfire. They've got some really interesting blogs and that. And they've also done, I will say, one interesting thing that same firm has done is a lot of simulations on looking at deal flow, a number of deals and portfolio construction. And I'm not just patting my own back, because I was really interested in reading it and then found out that they found very similar conclusions in terms of the number of deals and doing fixed checks and a lot of the other data that we've been looking at and decisions that we've made. So in short, yeah, that's a bit of a ramble. I do want to do more of that stuff. I think there's a lot more potential. Whether we have the resources and that to do it is probably the tough part of it. And Pierre asking, does your investing strategy take into account the switching in tactics as sectors change, or is it more led by super angels? It's more led by the super angels, and they're more on the ground, seeing what stuff is happening. So we will invest into what they're investing into, and they, as I said, they will change and invest in areas that become interesting. And we've got around 40 that we work with, so they tend to see a whole gamut of different sectors and things that are happening. Gosh, Carl, I'll cover that. I mean, I don't have got that data on the performance webinar, so I suggest you jump on and join for that. I'll talk about the cohorts for ourselves. I wonder if you actually you're probably talking about the full market cohorts. Yep, next bit of data we want to look at 2020, especially so we can compare it to the performance of our own fund and see how it's doing, good or bad. So yes, I think looking at the later stage cohorts will be good. I think as the caveat of just being that some of them wouldn't necessarily have had enough time to do follow-on rounds. The 2020-21, I think, is probably the most interesting one, because it should have enough time for us to actually see what's happening. So yeah, I think 2020 is the one that we would look at next. I know there are some, yeah. All right, I'm just double checking that I've caught everything. But yeah, as I said, if I missed everything, if you want to tell me I'm mad how to, feel free to email me and get in touch. I hope everyone's found this information helpful in making your own decisions and I guess understanding this market and seeing where it's headed. So thank you so much. I really appreciate everyone taking time on their Friday to join us, and I hope you have a fantastic weekend. All right. Cheers, everyone.